Hi guys, Max here, and of course yesterday was an absolute bloodbath in the markets, as you can see once more. We had actually some green movement the day before when the news from the Federal Reserve that Jerome Powell would be raising interest rates by 75 basis points. At first, markets rejoiced on that news because they saw it as a resolved, sharp Federal Reserve that is committed to fighting inflation, and they pretty much just ignored the fact that actually higher interest rates are really tough for the economy, and they're going to be tough for stocks that make up that economy as well. It took about 12 hours then for the markets to do a complete 180 and to absolutely collapse on really the exact same news. Nothing actually changed overnight between those two trading days. It was just investor sentiment decided to concentrate on something else, and they decided that it was bad. So as you can see, pretty much everything was down for the day. Tech in particular did really quite poorly. Apple down 4%, Microsoft 3%, Google 3%, Amazon 3%, and Tesla down by over 8% for the day. What else didn't do brilliantly? Well, financials, credit services in particular really didn't do too well, but not really banks. The reason for that is probably because companies like Visa and MasterCard and American Express will be expecting a recession to reduce the amount of transactions and the value of those transactions, and so their revenues, whereas companies like JP Morgan or Bank of America, well, they will actually benefit from higher interest rates because they get to charge high interest rates on their financial services products like car loans and credit cards. Now, the sector that actually performed okay, it still fell for the most part, but it didn't absolutely collapse, was consumer defensives, which historically should be mostly in line with recessionary thinking. They often see increased numbers of customers during downturns or recessions because people stop shopping at places like Whole Foods and start shopping at places like Walmart instead. As for the day then, how did the indexes perform? Well, the S&P 500 was down by 3.2%. The Nasdaq underperformed and was down by 4%. The Dow Jones did a little bit better and was down by 2.4%. And the Russell 2000 really had a bad day, spiking those recessionary fears once more and fell by 4.7%. This now means that we're once again at new lows for this bear market, new lows over the last year really. The S&P is down by 23.5% year to date. The Nasdaq is down by 33% year to date, so people are definitely starting to worry. Across the rest of the world then, what did we see? Well, we saw basically the same action again. The American equity market is just so massively dominant that actually investors can't really get away from it no matter where they live. The FTSE 100 was down by 3.1% and the Stoxx 600 was down by 2.5%. Again, this is mostly on recessionary fears, also a little bit on inflationary fears, but no sector, no country was safe. China was down, the rest of Asia was down, the entirety of Europe was down, and the rest of the Americas was down as well. Now, the dollar actually lost a bit of value, which is a little bit odd and not necessarily what we would expect in this circumstance. It fell by about 0.8% against most other major currencies. The euro rose by 1.1%, now sits at $1.06, and the pound rose at 1.5% and now sits at $1.25. And the yen actually rose as well by 1.4%, and there's now 132 yen to the dollar. Now, over recent days and weeks, we've seen the dollar act as a safe haven. So when equities sell off, actually the dollar tends to do a bit well, but that didn't really happen this time round. Now, in the fixed income asset market, the US 10-year Treasury yield fell by 5 basis points, and it now sits at 3.23%. Again, historically a very high level compared to where we've been over recent years. And actually that sort of makes sense on the surface. People route out of equities and risk on assets, and they put their money into safer stores of value like the bond market. In Europe though, we actually saw bonds move in the other direction with prices falling and yields rising. The German 10-year yield was up by 7 basis points and the British one up by 5 basis points. Finally, for traditional finance then, what happened with commodities? Well, with oil, WTI crude oil rose by about 1% again, and it now sits at $117 a barrel. Brent crude is sitting at $119 a barrel, still very high levels. Yes, we saw like 2 days of oil prices decreasing, but now they're going back up again. Don't get your hopes up. I really don't see this oil crisis ending anytime soon. Now, gold prices actually rose, which is what you would expect them to do as equity markets crash. Gold rose by about 2%, and it's now back at $1,855 an ounce. What happened in the crypto market then? Well, it was a bit of a mixed bag, but mostly just slightly bad. Bitcoin is still sitting at about $21,000, down 2% from yesterday. Ethereum still about $1,100, down almost 5% from yesterday. Most altcoins were down, but some of them did rise. Some centralized exchange tokens, well, they rose a little bit, like FTX's token and Crypto.com's token both rose. But for the most part, the crypto market is still in a downtrend, and that's not really going to stop anytime soon either. Now, one of the reasons for that is this 3AC, Three Arrows Capital, that we've spoken a little bit about over the last few days. Now, if you missed those videos, basically what's happening is there are rumors of insolvency amongst Three Arrows Capital, which is this massive multi-billion-dollar crypto investment fund. They could have exposure of as much as $18 billion to the crypto market in particular. They're based out of Singapore, and they are one of the biggest crypto investing or gambling firms, depending on how you look at it. Now, as of a few days ago, we were aware that this company was in trouble, but we weren't really sure to what extent or what's actually going on. Now, though, we do know exactly what's going on and why they are in trouble. They were working with the lending company BlockFi, who had lent them a whole lot of Bitcoin, hundreds of millions of dollars worth. And 3AC met their liquidation point, they met their margin call, and so BlockFi margin called, and they couldn't pay it off. Now, it does seem that they have now sorted that out. They're working with BlockFi, and apparently they're still on good terms and are discussing payment plans, and they're liquidating other parts of their portfolio to pay this debt off. It's not 100% clear what actually happened, but 3AC has lost a lot of money, and people are worried about its ability to continue. Now, they also had quite large exposure to the Grayscale Bitcoin Trust, which is basically just a company which buys Bitcoin on behalf of investors, and then you can buy shares of Bitcoin. So it's a way of sort of getting into cryptocurrency using tax advantaged accounts and things like that, and government regulation. In the past, GBTC, which is what it's called, or G Bitcoin, used to trade at a premium. It now trades at a distinct discount, which means that the money that 3AC put into this firm, into G Bitcoin, well, they're now sitting on massive losses there as well. Finally, we've also heard from a company called Finblocks, which is just another crypto lending platform, the same sort of thing as BlockFi, but apparently they haven't been very smart with the amount of risk that they take on, and they had a load of capital from 3AC, and they've lost loads of money from 3AC because of that, and so they've cut down their withdrawal limit to 2/3, meaning that you can only really take out 1/3 of your wealth of the coins that you've given to this company as a custodian. That's not good. That's eerily similar to what's happened in Celsius, though not quite as bad. They're still letting you take some money out. I'm not really sure why they've gone this route about it, but they're also claiming that they're doing this so that they can remain solvent and so that in the future they can eventually get everyone their money. Frankly, I'm a little bit skeptical of that. If they're in this position in the first place, it means that they're going to have to make up loads of extra money in the future, which means taking on more risk. And in a bear market, that's probably not going to go too well. Finally, there's just a lot of fear surrounding this 3AC collapse. A lot of investors are worried about what might happen next, what company might go down next. Some companies like Crypto.com have come out and said categorically, we have zero exposure to 3AC at all, so you don't have to worry about our insolvency. Some have distinctly done the opposite, so there is a lot of risk out there right now. Regarding the founder and manager of 3AC, Zhu Shu, I think his name is, well, he's still AWOL, he's still disappeared. He hasn't tweeted or said anything online as his company goes through these massive problems. He's still deleted his Instagram account, so really no one is sure what's on there, but there's a chance that he's trying to make a run for things. Now back into the real world, and we have quite a strong development regarding the EU and Ukraine, and of course Ukraine wants to join the EU. Now they are basically discussing giving Ukraine EU candidate status, which would then allow it to start the process of actually joining the EU as a full member, and that's quite a big thing because the EU also comes with a common defense clause and a bunch of other support. It would basically cement the EU, Europe, and even Western resolve against this Russian invasion, and it will probably be bad for Western-Russian relations in the long term. Now, what exactly is going on? Well, French, German, Italian, and Romanian leaders are there meeting in Kyiv with Zelensky. They're talking about the EU and talking about getting Ukraine to join, and they're all doing a little bit of show and tell, a little bit of press stuff as well. Now, it is worth noting that this is a notoriously slow process. While Ukraine might be able to get candidate status within a couple of weeks or months, it will take years minimum really for Ukraine to actually become a full member. For some countries, it's taken decades, and even then, it's not a sure thing either. As I said, though, this will pretty much cement the EU stance as pro-Ukraine and anti-Russian, and that's going to be bad for the energy crisis in Europe in particular. We'll talk more about that in a moment, because actually natural gas prices are spiking and things are getting bad there. And this is going to contribute to that. It's also going to have a negative effect on Western companies in general who used to have operations in Russia and may be looking to move back into that country in the future. Companies like McDonald's have obviously just shut down their entire operations there. They've just accepted hundreds of millions of dollars of losses, and they just said, yep, we're not going to work in that country while they're invading other sovereign nations. A lot of people have been hoping that those companies would be able to move back into Russia and recontinue business there, and that actually relations can normalize. This is probably going to make that a little bit less likely. It seems like we're sort of on the brink of entering into a new Cold War here. Now, European natural gas prices are getting really high once more, as you can see from this headline here. Now, yes, we did see massive natural gas spikes at various flashpoints during this war, when the invasion actually started, for instance, but mostly they were spikes up and then spikes right back down afterwards, while natural gas prices on average rose by major amounts, but they weren't quite as bad as those initial candles would have suggested. Now, over the last week, we've seen some more crazy news, which is making this worse. Basically, Russia started to cut the supply of natural gas to a couple of countries, the two big ones being Germany and Italy. At first, this was only by a third, but that's already risen to about 50%. Now, Russia is claiming that this is due to technical problems. They're claiming that it's, mechanical issues, and it's not politically motivated at all. That's very unlikely. Italy is very angry about this. They're saying that it is that Russia's just lying outright. Germany is also saying that, but in a little bit of a more diplomatic way. They're saying that it's extremely unlikely that this is not politically motivated. To be honest, yes, Italy and Germany are correct. This is clearly politically motivated, but this is also just geopolitics, and they shouldn't exactly be surprised by this. As a result, natural gas prices have risen about 50% over the last week. That's really bad for the entirety of Europe. It is summer and there is a heat wave, so it isn't bad for people heating their homes, but it is bad for electricity, which is going to go up with aircon and with manufacturing and things as a recession kicks into Europe. Higher energy prices are an absolutely awful thing. Now, Europe has neglected energy security for decades now, and over the last 6 months they've been trying to improve it, in particular with liquid natural gas imports from various places, mainly from the United States. The problem is this is an incredibly hard thing to increase capacity for. You need to build multi-billion-dollar ports and $100 million ships, and even then it's an expensive process and it isn't easy at all. Now, there were a lot of liquid natural gas imports coming over from the US, and they were being stockpiled in Europe for this sort of eventuality when Russia cut off or reduced supply. About a week ago, though, there was a fire in one of the largest plants in the US, and that slowed everything down, so that's worrying there. It means that liquid natural gas is not going to be as effective a replacement as the EU were hoping. In short, this whole situation is just bad for the EU. Inflation is already absolutely awful. Energy prices are already really damn high, and they're going to get higher. The EU itself is also under a lot of scrutiny regarding its monetary policy. It's stuck trying to service 27 different countries' needs, and it simply isn't able to do that. And countries like Italy are already showing massive signs of stress and struggle regarding rising yield rates, rising debt costs, basically. So things just aren't looking good on the continent. Now, thankfully for those who hate Elon Musk, he's been out of the news for about a week now, and we haven't really mentioned him on this channel for about that much time either. But unfortunately for those people, well, he did a video call with thousands of Twitter employees yesterday. He did it on his phone, and he answered a few questions and spoke to them all. And I'm just going to read out a few quotes, some of the interesting things that were said, and then we'll talk very briefly about what might come from those things. And then finally, what I think this means for the Twitter deal. And surprisingly enough, I do think there's some good news there. Now, the first thing Elon mentions is this bit here, where he basically says that he doesn't really care about having a title at Twitter. He isn't interested in running the company in particular. He just wants to drive it in a particular direction. That's almost certainly in the direction of, being a better business and making more revenue and generating more profit. But also supporting the ideas of free speech. We know that already. We've heard it from him time and time before. Now, free speech really being the driving force regarding this Twitter takeover and a lot of the controversy surrounding it. Well, he spoke a little bit on that as well. And he basically said that people should be able to say whatever they want on Twitter, including harmful speech if that's what they want to say. But Twitter doesn't have to encourage it, and they also don't have to promote it or push it out using their algorithms. He's actually spoken against Twitter's algorithms quite a lot, and he says that he would rather have Twitter's default page just be chronologically ordered tweets so that Twitter's biases don't get in the way. Then another controversial thing that Elon's been talking a lot about regarding Twitter is this idea that there are too many employees, that they don't work enough, and that he needs to make cuts in order to make Twitter a better business. And that came up once more. Obviously, his employees are wondering whether or not they're going to have jobs in the future. And he basically said that actually, yes, he still believes the same thing, that some people are going to need to lose their jobs, but anyone who is a significant contributor has nothing to worry about. Basically, anyone who's a good employee, who's actually worth their salt, they're going to keep their jobs. A lot of people at Twitter are worried about this, presumably because they don't believe they do enough work to warrant their jobs. That's the only real reason I can imagine this. Or maybe they're just worried they'll get caught in the wayside. Finally, he also reiterated this idea about working from home and how he wants people back in the office. He thinks they're more productive in the office and that they work better, and that his bias is strongly towards working in person. He didn't make any concrete commitments about forcing all Twitter workers to start working in an office again. He isn't going to at this point, I would imagine, but it may well go that direction in the future. Now, as you can see, there wasn't really anything groundbreaking said there. It was all the same kind of thing that he tweets about constantly. So anyone who's surprised by that really shouldn't be. Twitter's employees are still largely unhappy with that. They had a great big chat on Slack, and apparently 90% of them are still worried or angry towards Elon. They're still not happy with the direction that he wants to take the company in. And in particular, they're worried about him changing the way the company is regarding work from home, regarding free speech, and regarding just the amount of work that these people are expected to undertake. Now, I see this actually as good news regarding the Twitter deal itself and it going forward, assuming you want it to go forward. Frankly, I don't think he would be doing this sort of thing and open himself up to all of this scrutiny if he had no intention of completing this deal anymore. It also seems just like a normal thing that you might do when you take over a company. You meet with the employees and you get there and you speak to them and you get their thoughts on what they would like to happen with Twitter, and you can say the same things towards them and vice versa. Frankly, I think if you are betting on Twitter's deal go through, maybe you own Twitter's shares and would quite like to sell them to Elon at $54 because that's an almost 50% arbitrage opportunity, you should be seeing this move as good news. Finally then, we have a little bit more news from the UK and the Bank of England, our central bank over in my country, and it isn't actually good news. We had another interest rate hike of 0.25 percentage points or 25 basis points. And that's now 5 consecutive 25 basis point hikes in a row, which isn't an awful thing, but actually they should be doing more. And I'm a little bit disappointed in the Bank of England. Now, they also came out and said that they expect inflation to reach 11% by the end of the year, which is absolutely terrifying. I really hope it doesn't go that direction, but frankly, it probably will. Energy prices are still rising and they're not fully baked into the calculations for our CPI yet. The question has to be asked then, if inflation is going to reach 11% by the end of the year, where is the 50 basis point rate hike? Where is the 75 or even 100 basis point rate hike? Shouldn't the Bank of England really be doing a little bit more here? And in my opinion, I think yes, they should. And that's why I'm a little bit disappointed to see a 25 basis point rate hike. I would have liked to see something a little bit stronger. The reason they haven't done this is there are a lot of worries about the British economy right now. The Bank of England don't want to crash the economy. And yeah, a 1% rate hike would pretty much crash the economy instantly. So it is a difficult decision. I just think it's the wrong one. And I think that they're underestimating the hit that inflation is going to make to our economy in the first place. The reason I'm actually disappointed here and not just annoyed is because actually the Bank of England was quite sensible regarding inflation. They've been far more restrained than most other central banks like the Federal Reserve or the European Central Bank recently. They were the first to start hiking interest rates right at the beginning of the year. This is their 5th consecutive rate hike. So they were on track to actually be quite a sensible central bank. But it seems like that's no longer the case. They're now turning a little bit too dovish for my liking, and it's just a bit upsetting to see them fall from grace like that. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.